This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the markets have just opened for trade. Our top stories this hour. Asian stocks are set for a lower open after Wall Street slips on a tech sell-off, geopolitical tensions and bets on a smaller Fed rate cut. China traders are bracing for a rollercoaster ride as mainland markets reopen, with futures showing strong gains and Beijing's top economic planner set to give a briefing. Plus, we're live in Taipei at Hon Hai's annual Tech Day as a company best known for building iPhones looks now to AI and electric vehicles for new growth drivers. We do have breaking news just crossing the Bloomberg when it comes to numbers out of South Korea. The current account balance and trade numbers, the August goods trading surplus narrowing to just under $6.9 billion there. The August current account surplus there seeing a narrowing. This, of course, as we continue to watch signs for what this could mean for the Bank of Korea. Of course, a lot of concern when it comes to the household debt side of the situation and wavering when it comes to employment, but certainly Korean trade, as well as some of those sort of early indicators of global trade have remained pretty resilient. The services deficit coming in at $1.3 billion in August versus a deficit of almost $2.4 billion US dollars for July there. That current account surplus at just shy of $9 billion last year. That August surplus was seen at just $5.4 billion, Shery.
Yeah, we'll be watching those China-exposed stocks in Korea as well. Of course, the mainland markets coming back from Golden Week holidays. And we have seen really that huge rally when it comes to the Chinese markets, right? Hong Kong stocks, Chinese stocks listed in Hong Kong, jumping more than 30% in the past month already. Now, whether that rally is sustainable is a big question, right? I mean, a huge divide right now, whether it's really worth those gains. China bulls have been burned for the past 5 years. We'll be watching really the NDRC when it comes to more details about how those stimulus measures will be carried out.
Shery, given all of this expectation and quite a great deal of volatility, uncertainty, unsurprising that Chinese brokers just have really been skipping these holidays to truly try and beef up staffing for what is expected to be that hectic reopening. We've seen some pretty extreme record highs when it comes to account openings at major brokerages, according to local media. But you mentioned the NDRC, and that's sort of the next gauge to look out for, right? This scheduled press briefing on Tuesday by the National Development and Reform Commission. This is a top economic planner for China, will be closely scrutinised. The market obviously wants more stimulus on the fiscal side as a follow-up to that powerful package that was announced at the end of September. Bloomberg Intelligence, though, really kind of managing expectations, thinking that many might be disappointed. We might get more sort of, details as to how the previous package might be implemented, perhaps not more when it comes to fiscal firepower being deployed.
That renewed optimism about the Chinese economy has given some support to oil prices. And of course, we have geopolitical tensions continuing to ramp up. WTI crude right now past that $77 a barrel level. When it came to the Wall Street session, we actually had losses for the S&P 500 being dragged down by those tech stocks. We're seeing U.S. futures currently under pressure. What we're watching very closely, though, are Treasury yields continuing to surge. The 10-year yield above that 4% level. We haven't seen these levels in yields in about 2 months or so. That narrative now changing about where the Fed goes from here, and perhaps that 50 basis point rate cut being really thrown out the window given stronger labor market data that we've got recently. So the dollar was sort of unchanged overnight, but take a look at how we're setting up in Asia, because the Japanese yen continues to stay weaker against the US dollar at around that 148 level. And we have seen Nikkei stocks now gaining for the past 2 sessions, a little bit of pressure in the Japanese Asian future session. We will be watching the markets very closely because we do get labor cash earnings data out of Japan. And remember, it's really that wage growth, especially in real terms, factoring inflation, which will determine where the BOJ goes from here. So, Heidi, we're really watching also the offshore yuan at that 7 level as, of course, we gear towards that reopen in mainland China.
Yeah, this is a big question, whether this is a tactical opportunity or a fundamental shift, right? And as we were speaking about earlier, Shery, brokerages, stock exchanges in China gearing up for what is expected to be a frantic Tuesday reopening with the resumption of trading on onshore markets after a week-long holiday. Optimism is running pretty high that Beijing's stimulus measures will give shares another leg up. For more, let's bring our China correspondent, Min Lo, who joins us out of Hong Kong. So set the expectations in terms of how busy today could be.
Yeah, well, if Hong Kong equities and the China futures are anything to go by, we could be set up for a monster rally. The CSI 300 entered the break up 8.5%. We could see it return with a similar size gain, if not more, because the China futures A50 trading in Singapore was up some 17% over the Golden Week holiday. The HSCI, the Hang Seng China Index, tracking those Chinese enterprises listed in Hong Kong, was up some 11% during the Golden Week holiday. So certainly a lot of catching up to do for mainland Chinese markets, and brokerages have been saying they are seeing this huge surge in new account opening demand during the Golden Week. Staff were recalled back from their holidays to stand by 24 hours to answer to client inquiries, and we also know that the stock exchanges in China had been carrying out tests to ensure that we don't see the sort of glitches and delays that we saw 2 Fridays ago before the Golden Week holiday, when that overload of trading actually overwhelmed the system. And also we have the NDRC meeting today, so that could send investors on a roller coaster ride depending on whether officials actually meet or beat expectations there.
Yeah, I mean, given the markets are really expecting perhaps more fiscal measures coming from policymakers, but how realistic is that we're actually going to get that from the top economic planner today?
Yeah, so usually if China introduces a new fiscal package, that means raising the fiscal deficit, that would have to be decided by the State Council. It has to be submitted then to the legislature for approval. If China issues new special sovereign bonds, that is usually announced by the Ministry of Finance. But these officials from the State Council or the MOF, they're not going to be present at today's meeting. So that's why Bloomberg Economics believes that this briefing today is more about implementation of pre-existing policies or incremental new policies. So we're looking out for measures to boost demand, whether it's a consumption side or investment side. We're also looking for signals of which sectors of the economy could receive more government support, could be in the form of funding or more government-led investments. These could be sectors related to advanced technology or green transition, for instance, and also whether there would be a widening of the usage of local government bonds to, say, support the buyback of unsold homes, for instance. So these are the things that we're looking out for. We're not likely to get that number today in terms of the big fiscal package.
Min, we know that the property sector is really front and centre and key to a fundamental turnaround in the economy, right? We've had some pretty good data when it comes to home sales jumping during the holiday period, with no less than 130 cities offering perks and loosening of restrictions.
That's right. So before the holiday, we had the PBOC announcing these slew of measures, right? Lowering down payment ratios for second home purchases, lowering mortgage rates as well. So over the holidays, we did see Beijing, for instance, expressions of intent to buy new homes double in the first 3 days of October. In Shenzhen as well, sales of new homes jumped more than 10 times, and visits by prospective home buyers up at least 50%. That's according to state TV. So we are already seeing an immediate increase or an impact from those measures that were announced before the holidays. But how long-lived will this rebound be is the big question. Analysts are saying that more measures are still needed, that the current measures will only lead to a limited rebound here, because the broader economic recovery and confidence around income and jobs, that still needs to recover for us to see a sustainable turnaround in the housing sector.
Bloomberg's China correspondent Min Lo there, and a lot hinges on this reopening as mainland markets, as we've been mentioning, coming back from that week-long holiday. And take a look at the expectations, because in the meantime, in the rally that we've seen going into markets going away on holidays, we've already seen that return when it comes to MSCI China valuations going back to that historical average of 11.5 times. We're also seeing, if you take a look at this chart showing the CSI 300's daily percentage change, the last session saw the biggest gain since 2008. We could see something similar once onshore markets come back online to catch up or adjust to those moves that we've seen in offshore markets. But our next guest says any kind of sustained rally for China will require investors to view the economy as a strategic rather than a tactical investment. With us now is Kerry, who's a global market strategist at JPMorgan Asset Management. I mean, this is really key here, right? And Kerry, I do wonder, you know, which way you're sort of leaning at this point with the data and the policy measures that we have to date.
Good morning, Heidi. Well, I think it's still a case of seeing this as something that has momentum given the enthusiasm around the market, but to really see it becoming something more of a strategical play towards China really needs to be reinforced by the announcement of those fiscal packages, particularly in terms of how they're going to address the housing market and reduce some of that inventory overhang, and also how they're going to sort of just improve their household balance sheets, whether that's through the wealth creation side, and to drive that consumer demand. So far, policies have been focused on the supply side. The more they come back to being on the demand side, the question then is about how effective they will be. And I think we need to see that reflected in the economic data and generally an upward shift in the economy in China to really see this become a much more strategic and long-term in terms of the investment outlook for China. But for now, I think there is definitely a lot of support for the market coming through. There is just a case of whether the market may be a little bit disappointed if they don't get what they expect on that fiscal package, given that we don't think it's going to be as big as what we've seen in prior cases such as 2008.
We've seen a lot of adjustments of views already, right? Goldman saying we could see another 20% when it comes to surging Chinese stocks. I wanted to get your views on our MLive blog question of the day, which is by the time we get to the end of the month, we're not even looking sort of any further into the future here. Where are Chinese equities going to be? So I suppose that goes to whether this is kind of FOMO flows we're talking about, you know, maybe covering short positions, or whether policymakers can kind of create a fundamental basis for hope here.
I mean, that's a very difficult question to answer, given on such a short time frame. I think it really does come back down to the fact that there is still a lot of money that could be attracted to the Chinese market if you get a lot of pickup in, say, international investment. We do know that initially this has been driven by, say, retail investors locally in China, or perhaps sort of hedge funds and positioning around China at the near term. So that can create some volatility if you do get that disappointment. For it to become something that's much more meaningful, I think you do have to attract a lot more of that sticky money from institutional investors to really see the momentum in the market move higher. So again, in the next month, we're going to have, you know, the US election, which could also have bearing on the outlook for Chinese equities. So I think it's a very difficult to call to say exactly where the market will be by the end of October.
How much would a real turnaround in the Chinese economy and Chinese markets have of an impact when it comes to the U.S. economy and markets? I mean, we have seen this resilience in the economic data out of the U.S., and we now have yields above 4%.
Yeah, I mean, it's a great point. I mean, the concern around the US this year has been from an economy that's running too hot to one that might be running too cold. And again, now coming back to the fact that you have an economy that can operate with high level of interest rates and still expand the job market and see the unemployment rate tick down. So it's all about how much easing actually has to need to happen in the US right now compared to market expectations for the economy to continue to expand. And I think those expectations are being dialed back to a certain extent. But if we do get the US economy expanding, if we get Chinese economy starting to expand, I do think the measures announced so far will create a bit of a floor to that growth outlook. I mean, that's generally good for the global economy and generally good for risk assets more broadly. So I think that does feed positively in terms of the soft landing scenario around the world and seeing the continuation of equity markets performing in this environment.
What's the path for treasuries right now, and how much of a shock do you expect from U.S. inflation data later in the week?
Well, expectations for US inflation are again at the headline level to see it drop down again by a few tenths of a percentage point, into the low twos. Core inflation is probably going to be a little bit above 3%, but again, trending in the right direction. And that does mean that we should see an asymmetric profile for bond yields in this environment. We still expect the downward shift in central bank policy rates around the world to mean that you do get a fall at the short end of the curve. Those movements higher in the 10-year we've seen in the US and in Australia overnight, I mean, that's just a reflection of the fact that growth is a little bit better in the US and that maybe it's going to hold up a little bit more. So you should see those yield curves steepen throughout. But again, it does mean that, you know, we shouldn't be rushing into a massive overweight position towards duration yet, because we see those yields being relatively range bound. But I still think there's a case for thinking about a more neutral stance towards duration, given some of those shocks that could emerge, whether it's, you know, a price shock in oil that could come through, perhaps a downward shock to growth in the US, you know, something that would upset the sort of quite positive narrative on the equity markets and investors having that resilience in their portfolio. But as long as those rate cuts come through, we see inflation come down, we do feel that yields should fall on the back of that. They may just not fall as far as many investors have expected to them, or as much as history would say they would fall, given they have rallied quite a lot ahead of that first rate cut by the Fed.
we may see Aussie bonds underperform going into the RBA minutes. Is there anything that you're looking out for? And I guess more broadly in terms of the policy trajectory for the RBA, clearly that more hawkish pause contrasted against a lot of other central banks that are already easing.
Yeah, it's a tough one because the RBA does look relatively more hawkish to other central banks. Obviously, inflation here is a little bit stickier. They're contending with some of the ramifications of the fiscal support that have come through both the state and national level that's impacting the inflation numbers as well. And growth has actually been quite weak in the last quarter or so. But I really want to focus on how hawkish they are relative to their last meeting. Obviously, the fact that they removed that sentence about talking about rate hikes at that last policy decision is quite key because they are thinking about the fact that policy is pretty much at its top and really seeing if there was any further discussion around the need for rate hikes at all. If not, if it's just about thinking about when they're starting that rate cutting cycle. We do believe they're going to start in the first quarter of next year and be looking for any sort of reinforcement that they are looking for that easing trajectory to begin next year, or if they're just quite happy to stay pat, as it were. So I think that hawkishness relative to their last meeting is something they'll be really looking for in those minutes.
Kerry, Craig, always good to have you with us. Global market strategist at JPMorgan Asset Management. Coming up on the Asia trade, Samsung's preliminary third quarter earnings report is due in a few minutes. We'll dive into those numbers with CLSA. Morningstar joins us to preview the reopening of mainland Chinese stock markets. And we'll discuss Australia's moves to create guardrails for the AI ecosystem. We have much more ahead. This is Bloomberg. Samsung is expected to report record high revenue in the September quarter, boosted by a recovery in chip prices and strong demand for AI supporting products. Bloomberg Tech reporter Yulim Lee joins us now from Seoul with more on this. And Yulim, of course, we know that Samsung has suffered so much, 20% downside on its stock. What are we expecting to see today when it comes to their earnings results?
Yeah, sure. The market is expecting Samsung's quarterly operating profit to come at 11.5 trillion won, which is about $8.5 billion. The consensus estimate has been coming down about 20% in the past month alone after analysts cut their outlook and target prices. And it's reflected in the Samsung prices, which is, as you mentioned, down more than 20% this year, underperforming the benchmark Kospi index and its rivals. It's really the reflection of challenges Samsung is facing in its semiconductor business, which accounts for more than half of its operating profit. And it's really critical to the overall business. One of the main challenges is it's been struggling to catch up with the smaller rival SK Hynix, which has secured an early lead in the high bandwidth memory chip market, which is really critical to to be paired with NVIDIA's GPUs. So, investors have been very disappointed that Samsung has lost this great opportunity. And, the HBM market alone has expanded very quickly from about $4 billion last year to maybe more than $15 billion, according to some estimates. So that's one challenge. And another one is obviously it's a foundry business. In 2019, Samsung made a big announcement that it wants to be a leading player in the foundry business, and it wants to really catch up with TSMC. But and it's made a significant investment in this field, but it has really been struggling to catch up in terms of market share, and the gap has been actually widening in recent quarters. So that's another really challenging situation for Samsung. And according to the analysts we spoke to, the PC and mobile customers have cut their outlook for procurement for the second half, because in the first half they were ramping up their orders, expecting the AI demand to be quite strong in the second half, with all the new product like PCs with AI features and so forth, but it really turned out to be not as strong, the demand. So it looks like they're taking a pause. So all this is playing a part in Samsung's earnings,
right.
And investors will be really keeping a close eye on the semiconductor business outlook.
Yeah, what are we expecting when it comes to the mobile segment, right? Do we see the impact of new foldables, I should say, and the OLED part of the business too?
Yeah, foldables, it was launched recently, so they're going to get a boost from mobile business. These are premium new foldable segment. So usually they tend to have a benefit from the new launch around this time of the year. So analysts are expecting that to be a boost to the overall business. But obviously today is a preliminary earnings, so we're not going to get great details. They're just going to announce operating income and revenue for the third quarter. We're going to get all detailed report at the end of this month.
Bloomberg Tech reporter Yulim Lee there with what we can expect from Samsung earnings. Of course, they will be out in just a few minutes. We have more ahead on the Asia trade. This is Bloomberg.
Continuing to monitor what's going on in the Middle East, let's take a look at the latest. Hamas fired a barrage of rockets towards Tel Aviv on Monday, 1 year after the Gaza militant group launched its attacks on Israel. Sirens sounded across central Israel, but the military says it intercepted most of the rockets. Officials say Hezbollah also fired 135 rockets at northern Israel on Monday. Israel sent troops back into northern Gaza at the weekend, while it also wages a ground and air offensive against Hezbollah across its northern border with Lebanon. Taking a look at how all of this is playing out across energy markets, which have, of course, been on edge for really weeks now, but increasingly we're seeing more of that sort of premium and risk being priced in. Brent has surged to $80 a barrel as that risk continues to play out for investors. We're seeing New York traded crude higher over the past 2 days by over 4% there. These mounting tensions and increased activity raising speculation that Israel may still be thinking about attacking Iran's oil infrastructure. We've had a 3.7% rally on Monday for the global benchmark, just extending that surge last week. Much more to come. This is Bloomberg. Let's take a look at what we're watching when it comes to trading in the bond markets in Australia. We're seeing that decline for Aussie bonds, local trading resuming after the holiday that we had on Monday in New South Wales. That yield curve bear flattening following that public holiday. And of course, we are awaiting RBA minutes as well, Shery.
And Haidi, this, of course, as we get labor cash earnings out of Japan. And right now, real cash earnings year on year, a contraction of 0.6% for the month of August. Now, this is the first time the real wage growth has turned negative in 3 months. Of course, it really will veer where the Bank of Japan goes from here. The headline number growth of 3%, which is a little bit higher than expected from 2.9% in the month of August. This is the year-on-year number, although we do have to account for technicality because we do understand that in July there was that boost from delayed payments for pay rises agreed by the labor negotiations that happened in the spring, and that was taken out from the month of August. So we're now seeing the contraction when it comes to real cash earnings year-on-year of 0.6%. We're also watching household spending year on year, which has also again contracted 1.9%, but it's a smaller contraction than was expected by economists. It's also a contraction from being slightly in positive territory, but this number has been fluctuating back and forth, Heidi.
Taking a look at Shery, we also have the Westpac consumer confidence numbers for Australia. We're seeing that big jump in October. Households now believing that the RBA has concluded its campaign of hiking amid these signs of a moderation in the inflation. We've seen that consumer confidence gauge jumping 6.2% to a 2.5-year high, in fact, to 89.8 points. This is the highest since the RBA actually kicked off that tightening cycle in May 2022. Still, though, in context, and that needs to be given, heavily in pessimistic territory. 100 is the dividing line with optimists. So Matthew Hassan at Westpac saying that expectation has really been supported by rate cuts abroad, more promising signs that price pressures are moderating locally. Consumers are no longer fearful that the RBA could take interest rates higher. But that strength of pessimism is still being reflected in the responses when it comes to family finances in particular. So it does seem like on the side of the progress on alleviating cost of living pressures, that is still kind of pretty slow progress, given that rates are sitting still at that 12-year high of 4.35%. And of course, we are getting those RBA minutes from the most recent meeting, but so far it's signalled that it doesn't intend, at least in the near term, to join the likes of the Fed, to the RBN said, in easing policy anytime soon. This is a picture as we take a look at how stocks are trading. We're about half an hour into the start of cash trading. A little bit of softness there for Aussie stocks, and we do have bonds just sort of playing a little bit of catch up there after Monday's holiday. Kiwi bonds, I should say, going in the opposite direction. We're watching tech as well, particularly here in Asia, with the Taiwanese industry giant Foxconn holding its annual Tech Day in Taipei. They're formerly known as Hon Hai, of course, the largest contract electronics maker in the world. It's now pushing to diversify and build more future-proof income streams. Our tech reporter Annabelle Jewellers looks at the challenges ahead.
iPhones, the Kindle, Nintendo Switch, even Ring doorbells. Foxconn is making these and more. Assembling the devices mostly in China has allowed the company to build an enormous business, generating nearly $200 billion in revenue last year. But the market for many types of electronics, and particularly smartphones, is maturing. Foxconn wants to move up the value chain to products that generate better profits. AI servers is one area where it's making progress. Sales have risen as Foxconn works with the likes of Nvidia, Microsoft and Amazon on artificial intelligence infrastructure. Semiconductors is another field with a focus right now mostly on older, less sophisticated chips. At present, these mostly go toward in-house needs, including EVs. This is an additional space where the Taiwanese company wants to compete, with a value proposition similar to what it once told Apple. Foxconn can build part or all of your car in less time and at lower cost.
We believe this contracted and design manufacturing service goes same way as smartphones and laptops. So we will have 40 to 45% market share in the futures.
Goldman Sachs says EV outsourcing could be worth more than $140 billion by the end of the decade.
But with Foxconn still to sign on a major customer, its grandest auto ambitions are yet to be realised.
And Annabelle now joins us from Hon Hai Tech Day in Taipei. Belle, with all of the optimism around tech, EVs and semiconductors around Taiwan, what can you tell us about the mood there?
Well, the mood is going through the final testing actually right now, so apologies for the sound, but it does seem like they're doing some checks and balances. But it is the 5th time that Hon Hai is holding its Tech Day. It's the 50th anniversary as well of the company, and it comes, as you just heard there, at a time when the company is really focusing on what's going to be the next big growth driver. We can talk about AI servers in just a moment, but in the short term as well, the other focus is on electric vehicles. And you can see behind me some of that vehicle lineup. 2 new models are going to be unveiled in just a couple of hours' time. Of course, Hon Hai, it's a business that generated nearly $200 billion in revenue last year. I asked the man who's leading Hon Hai's EV efforts, Seki, when the electric vehicle arm will actually start to meaningfully contribute to the bottom line. Take a listen.
North American market specific, but also Southeast Asians and Japan.
The North American market, a lot of that production could be done by your plant that's located in Ohio, in Lordstown there. That's a plant that is permitted to manufacture up to 350,000 vehicles per year.
Possibly, yeah.
Right now you've got tractors that are going through. but you're quite a long way from reaching that 350,000 production capacity. Do you see a time where you think the assembly lines could be working at 100%?
Of course.
What sort of time frame?
Let's say 5 years. 5 years is not long. We started the concept of EV like 2020s, now 2024. I think almost same range, we can make it full. But our policy is we want to be very close to our customers. And then we go like 150,000 for Ohio's. But we don't determine yet if we go next step in Ohio or any other place.
But you do expect by the end of 2030, then, by the end of this decade, to be manufacturing up to 350,000 vehicles in the US?
USA, yeah, or more.
There is a point at which it could make more sense for an OEM, a car manufacturer, to manufacture in-house by themselves. Mm-hmm. Some in the market would say that's around 50,000 units per year. Mm-hmm. How many customers do you need then to make that Ohio plant profitable?
It will be different depending on customers. And most of the customers start with very small volumes, but when we're looking at their volume requirement in 28, 29, very large. So with a timeline 29, 30 base, 300,000 vehicle is, let's say, minimum 3, and maximum 10.
So between 3 and 10 customers you would need for that to be...
3 and 10 vehicles.
3 and 10 vehicles?
Vehicles, yes.
How many customers then?
If customer has 5 is maybe enough.
But I guess it comes back to that same point around the cost analysis. How are you talking to legacy car makers about why it makes more sense for them, financially speaking, to outsource their production capacity to Hon Hai instead of doing it by themselves?
Yeah. We experienced exactly same through laptop. Like 20 years ago, one laptop was about $3,000, $4,000. At that time, most of laptop player built by themselves, and then laptop price coming down, and then some small player couldn't maintain manufacturing by themselves, and then at the same time, like EMS, electric manufacturing service players coming, and then it's shifted from OEM to outside service players. And then while laptop pricing is coming down, actually their profitability going up because we manage their manufacturing better than in-house. And then this is same for smartphones, game machines. Why not for vehicles?
So as you just heard there, they've got some very, very big ambitions in this space. Of course, they've got a lot of excess capacity or capacity that's pretty much going underutilized right now, particularly at that US plant in Ohio. But the company is still really dreaming big in this space, and they're doing it with some partners as well, who we're going to be speaking to later today. One of those is Pininfarina. They're the vehicle designer, rather, from Italy, the designer of Ferrari, actually, initially. We're going to be speaking with their CEO today. We'll also be hearing directly from the chairman of the business, and this is a really big interview to be watching out for. Again, we'll be speaking all about the AI servers and that really big growth driver that's emerging for Hon Hai as well.
We'll be looking forward to those conversations. Annabelle Druller's there joining us from Taipei. Take a look at how Japanese assets are trading. We saw a little bit of a reaction on the Japanese yen as we got that wage growth number. We saw wage growth slowing a little bit for the month of August. It's actually deeper into these numbers with Tokyo Economy Government reporter Erika Yokoyama joining us now. So nominal wage growth also slowing, but also real wage growth also dipping into contraction territory. Should we be at all worried about this?
I don't really think so, actually, because, you know, that over the last 2 months, headline figures are pretty much pushed up by the temporary factors like bonuses, as company wanted to adjust the workers' payment with bonuses to reflect the wage, the result from the wage negotiation area, right? What we really have to look at the underlying trend, for example, the base salaries for regular regular workers that saw a record growth in August. So I think that is an indication that the wage momentum is still sustained in Japan.
In that sense, then, I guess the government can be a little bit more comfortable and perhaps breathe a sigh of relief as we have a new administration now in Japan?
I think it is a tailwind for Prime Minister Ishiba, especially ahead of the election. But, you know, the bigger picture is a little bit complicated due to the strong inflation. You know, like if wage gains cannot keep up with even stronger price hikes, the voters wouldn't be fully satisfied, right? And in recent opinion polls, it shows that the voters are most concerned about wage measures and inflation measures. Then Ishiba already responded to that, actually, by stating that his top priority is end of deflation, and the wage growth is key to that, right?
Erika Yokoyama, good to have you with us. Tokyo economy and government reporter breaking down those wage numbers here out of Japan. Critical on where the BOJ goes from here. We have more ahead. This is Bloomberg. We're still awaiting Samsung preliminary earnings. We're expecting record high revenue in the September quarter. Let's bring in our next guest who has an outperform rating on Samsung with a target price of 100,000 won. With us now in Seoul is Sanjeev Rana, head of Korea research at CLSA. Sanjeev, good to have you with us. Of course, we have seen the skepticism about Samsung in the markets, 20% downside when it comes to its stock this year. Why are you so optimistic that we could go still further up from here?
First of all, good morning, and thank you for having me on your program. Samsung's share price is down 30% from its peak in July, and for right reasons, because there are some concerns about the memory cycle. You know, we have seen some weakness in memory pricing, especially for legacy DRAM products. But our view is that we think this is just a transitory thing, and as we move into next year, sometime by 2Q, we are likely to see re-acceleration in memory prices. This is primarily because companies are converting more of their like traditional legacy DRAM capacity to high bandwidth memory, and which is more profitable, and we expect high bandwidth memory-related demand next year to be very strong, almost 100% increase in shipments we are expecting for Samsung. So overall, I mean, these like the headwinds that we have seen for memory pricing, we think they are just transitory, and beyond that, we can expect memory ASPs to accelerate, and we also expect improvement in the company's foundry business down the line.
So we are getting Samsung's third quarter sales numbers right now, 79 trillion won. The estimate was for 81.57 trillion won. When it comes to operating profit, also below expectations at 9.1 trillion won. The estimate was for 11.48 trillion won. So right now, the headline numbers coming in slightly below expectations. We were still expecting that record high revenue given the recovery in chip prices and, of course, strong demand for AI supporting high bandwidth memory. As we've been discussing at the moment, we'll get a little bit more of a breakdown of these numbers. But, of course, the final breakdown divisional comes later in the month. Right now, third quarter operating profit slightly below expectations, 9.1 trillion won. And Sanjeev, since we still have you with us, get your reaction on what do you make of these numbers and perhaps your thoughts on the concerns in the markets right now that the certification by NVIDIA when it comes to Samsung's most advanced chip is getting delayed.
So the weak third quarter was somewhat expected. Consensus estimates for Samsung's third quarter operating profit fell from about 13 trillion won to like less than 10 trillion won in the last 6 weeks or so. So we think that the weakness in the profit was mainly because of its semiconductor business, especially memory. Given the sluggish demand for PCs and smartphones, we think their bit shipments came below guidance, and also given the fact that there has been some continued delays in getting product qualification approval from NVIDIA, so HBM shipments likely also missed expectations, and that affected overall fiscal earnings. In addition, we think there were some labor bonus related some one-off items as well. So yeah, I think this was expected to an extent. Regarding the HBM qualification, we anticipate Samsung to receive HBM3E product qualification from NVIDIA in the coming weeks. The company has been, trying to get approval from NVIDIA in the last 6 months or so, and we believe they are very close to getting it. So on the back of this HBM3E qualification, we expect a significant improvement in their HBM revenue in 2025. So we expect near doubling of Samsung's HBM revenue next year.
Sanjeev, we're just getting a few more lines coming through from Samsung now, and really saying that the third quarter chip earnings decline was a quarter-on-quarter decline off the basis of one-off costs as well as FX. The third quarter earnings reflect one-off costs when it comes to bonus payments as well. So in terms of, I guess, the sort of idiosyncratic factors, is there more reason to believe that this disappointment is something that they'll bounce back from in the coming quarters?
Yes, we think so, given that we are expecting a significant pickup in companies' high bandwidth memory shipments. And these HBM prices are typically like 4 to 5 times that of a conventional DRAM products. So not only we will see some improvement in ASPs, but also the profitability is expected to improve. Also, on the company's foundry business has been making losses for the last several quarters. We expect the extent of losses to actually decline somewhat in the coming quarters. So currently, if you look at the stock, it's just trading at like around 1 times forward book. We think at these levels, it's reflecting major negatives, and the stock is primed for a rebound. So for that, we need a few things. So if Samsung can, can gain qualification from NVIDIA for its HBM3E, which we expect actually, that will be an immediate catalyst for the stock. And as I said, it's just a matter of time. And second is that if company announces some capex cuts for their memory and foundry business, that will be actually positive, given the sentiment around memory pricing is currently not so good. If company cuts its capex guidance for this year or next year, I think that will be taken as positive by the market.
Samsung saying chip earnings reflected clients' inventory adjustment as well, acknowledging that third quarter earnings have fallen short of market expectations. Also talking about China companies' legacy supply, that rise also affected earnings. I wanted to get a quick view from you about the mobile segment, because Bloomberg Intelligence expecting that over the next sort of 5 years or so, we're going to see the majority of mobile revenue growth to come from foldables. How much will that benefit Samsung?
So Samsung is a pioneer in foldable phones, and they have still the dominant share of the foldable phone market. It's just that foldable phone as a product category has been very slow to pick up. Customer adoption of foldable phones has been below expectations, I should say. So Samsung launched foldable phones in 2019, and even after like 4 or 5 years of launch, the shipments of foldable phones remain like pretty like around 10 million plus plus units or so. But I think every year we are seeing some improvement in foldable shipments, and as foldable technology improves, I think product is likely to be to gain more traction with the customers, and we expect Samsung to maintain its dominant position in the foldable phone markets in 3 to 5 year view.
In the meantime, right now, Samsung actually apologizing for their earnings not meeting market expectations. Sanjeev, Rana, good to have you with us, head of Korea research at CLSA. Of course, we'll be watching the Open in South Korea for Samsung's reactions. But right now, we're getting breaking news out of Japan. We are getting right now the current account surplus for the month of August coming in slightly higher than economists had expected at 3.8 trillion yen. The trade deficit also smaller than expected expected at 377.9 billion yen. The adjusted current account surplus at 3 trillion yen. Of course, the Japanese currency was at around that mid-140s level during the August period. Right now, current account surplus beating to the upside. This is Bloomberg.
Just recapping the Samsung numbers, and of course we've seen Samsung apologising for the earnings not meeting market expectations. They posted profit and revenue that fell short of those expectations, stoking now some uncertainty when it comes to outlook for its pivotal chip division in particular. We saw that preliminary operating profit of about 9.1 trillion won or $6.8 billion in that September quarter. Expectations were for 11.5 trillion won. Revenue also came in a little bit short. A full financial statement with net income, the sort of divisional breakdowns, we'll be getting that later this month, but certainly some weakness for investors to be concerned about.
Investors really watching how they manage to catch up to SK Hynix in the memory chips used for AI, not to mention how much progress they make in really going against TSMC in the production of custom-made chips. But so far, we have seen, of course, Samsung, as you can see right there, a decline of more than 20% this year. We'll be watching Samsung and other semiconductors at the open in South Korea and Japan as well next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and we'll be watching semiconductors and tech, Haidi, not only because we had Samsung missing expectations both on revenue and profit, but because we had the tech mega caps overnight dragging Wall Street down.
Also watching for the return to trading when it comes to mainland Chinese markets. Right, we've already heard that brokerages and a number of staff really skipping the holiday to prepare for what could be a hectic trading session as sort of onshore assets potentially tries to play catch up to the gains that we've seen in offshore assets. A question, Shery, of course, remains whether this is a tactical or a strategic change on how investors are viewing Chinese assets.
We'll be watching those China-exposed stocks even in the Japanese session. Of course, we have a lot of consumer names that operate in China as well. Right now, we continue to see that pressure on the Japanese yen trading at around that 148 level at the moment. And this really has propelled Japanese stock markets in the last two sessions. For today's session, though, at the open, we're seeing downside of 0.8% for the topics. Those tech-heavy names really feeling the downside pressure. Of course, semiconductors will be key to watch. We also had labor cash earnings showing the wage growth slowed here in Japan for the month of August. Still, what was really interesting was the base pay for regular workers kept growing at a record pace. So that seems to really not change the calculation much for the Bank of Japan. Take a look at how Korea is opening at the moment. As I said, Samsung has been pressured recently, 20% downside when it comes to its stock for 2024. Right now, we're seeing Samsung down about 0.8%. Really, management apologizing to markets for the earnings not meeting expectations. The broader Kospi and Kazakh also being dragged down at the moment, Haidi.
Let's take a look at what we're watching when it comes to Australia. We're just an hour or so into the cash trading session now, and we are seeing that downside really as a result of the lag that we're seeing in some of the financials and banks. We do have the RBA meeting minutes, and of course we'll be looking to glean some more details as to the reasoning why, of course, the RBA has remained really on this hawkish pause versus other central banks from Wellington to Washington already choosing to start their easing cycles. We're seeing consumer discretionary sectors also weaker as well, which is interesting given we've actually saw Australian consumer confidence jumping to a 2.5-year high. The Westpac numbers suggesting that we are seeing an alleviation a little bit, but still, of course, heavily in pessimistic territory, and also indications that there's quite a bit of pessimism when it comes to family finances, that progress on cost of living pressures remains still quite slow to improve. The Aussie dollar is much unchanged. 67.55 is what we're watching at the moment. Also taking a look at US Treasuries. days, where we also did see, Shery, from the Ministry of Finance saying that the Japanese market has actually bought up a record amount of US sovereign bonds in August.
Haidi, Samsung continues to be under pressure. Of course, we just got the earnings. Let's bring in Asia Stocks reporter Yu-Kyung Lee to dissect this. Yu-Kyung, what stood out for you in the numbers?
Good morning. Samsung has reported the preliminary earnings result. What really stood out this time is that the company's vice chairman has issued an apology, a rare apology. It was a long one. And the company said it not only apologized for not meeting the expectations of investor with this third quarter earnings, but it also said the company will make full-fledged efforts in order to enhance the business competitiveness and address the market concerns. And there has been a lot of market concerns lately about Samsung's share price move. If you look at the latest share price moves, the company's shares has fallen almost 30% from the July peak. And there has been a lot of market concerns that has been raised lately, which shows a big change in how the market has been perceiving Samsung. There has been a lot of optimism earlier this year that there will be a big rebound in the Samsung prices, but that optimism has turned into a pessimism all of a sudden, and Samsung has been seeing a really sharp drop in the share price lately.
Can that outlook when it comes to the share price is a big drop that we've seen potentially move, if this is kind of being seen as a point where we could get some improvement from here?
So that's probably what Samsung executives are trying to convince investors, that the company is going to try to make a turnaround and is going to make a huge effort to catch up to rivals. But we'll see when the market opens how the investor will be taking the messages from the Samsung. What's very unusual lately has been that even though the Samsung share prices has been dropping quite sharply, we haven't really seen the dip buyers because Samsung's semiconductor is a cyclical business. When the share price sharply fall, there always has been some dip buyers in the market. So there has been some bottom in the share prices, but this time we are yet to see the dip buyers in the market. There is certainly a view that a lot of the bad news has been out there already, so there's only a way to go up for the Samsung share prices, but still, I don't really hear a convincing buy call on Samsung from investors yet. We may have to still wait and see how Samsung is going to navigate through this crisis.
Samsung's stock price right now, paring back some of those earlier declines, down 0.3%, but we do have the likes of SK Hynix perhaps also falling in sympathy. When it comes to Samsung, the narrative really has been about not being able to catch up in the AI chip space, right, with the NVIDIA certification. What are we seeing broadly in the semiconductor space when it comes to South Korea?
So what I've been hearing from the investors lately is that there has been some of the bearishness on the overall semiconductor sector. If you look at the semiconductor sector, the legacy memories are still the dominant, take the biggest part of the semiconductor, and the HBM or other AI-related devices are still a smaller portion when it comes to the sales. So the companies that can benefit from the AI rally are quite limited. So this is a really bad news for a lot of the chip suppliers and the company that supplies to Samsung and SK Hynix, which are mostly listed in the small cap cost stock space. That the legacy DRAM and memory products are not seeing a strong demand, which needs some big buying from the consumers around the world for the new types of PC and smartphones. And without those consumer demand recovering, we may not see the full rebound happening in the semiconductor industry. That's the big part of the South Korea's economy.
Our Asia Stocks reporter Yu-Kyung Lee there with a reaction to Samsung earnings. Let's bring in Lorraine Tan, Director of Asia Equity Research at Morningstar, for a broader view of the Asian markets today. Lorraine, good to have you with us. We're talking about semiconductors. Of course, Samsung is a big part of the South Korean market, but semiconductors in general across Asia, not to mention broader hardware tech as well. Such a big sector for Asian investors. How do you view this market right now?
Hi, good morning. I think basically it's the tech names, because they have outperformed quite a fair bit in the past year. We've seen some rotation out of it this year. So unsurprisingly, because valuations are a little bit closer to fair value in our mind. And so that's adding to the impetus to move into more growth, really, or rather more cyclical sectors, given that interest rates are coming down and the consumer cyclical, consumer defensive stocks are the ones that are relatively undervalued now.
Yeah, we have seen that sort of narrative, especially play out during this Chinese rally and as we head back from Golden Week holidays in the mainland, right? Are you expecting that huge pop, and how sustainable is this?
Well, the thing is that if we look at, 2 weeks ago, we had a 21% discount to our fair value estimates for our Chinese names using 8 shares as well. And now when we look at it, it's only a 4% discount. So while there are still selective buying opportunities there, I think a lot of the sectors are actually closer to fair value. So while we do anticipate a pop, we do expect more policy news to come out that would support share prices. We'd probably be a lot more selective going forward for anybody who wants to play into the uptick. We do think it's positive news, though, that we expect, but there's not enough there that would change our base case views. Let's say, for example, for housing prices to basically stabilize and bottom out in the second quarter of next year, and that would help consumer consumption in China.
Lorraine, I wanted to get you to our question of the day on our MLive blog, which actually asked, even the sort of short-term view as to where Chinese stocks head from here, whether we end the month, at what point higher or perhaps not much of a rally from here at all. It sounds like you think perhaps that they're sort of more priced for the potential downside if there's disappointment.
Yes, I would think that would be the case because it's run up so strongly. Having said that, everybody was so underweight Chinese equities that there wasn't a lot of selling pressure on the uptick. So what we may see, it's still going to be, I think, if there's disappointment, it could come down fairly sharply. But at the same time, we do think policy news is going to be supportive for the near term.
What do you like then, if there is going to be sort of some significant readjustment of expectations? Are there sort of sectors or names that you think will be able to withstand the volatility?
Yeah, so what we're seeing now is that, as I mentioned, the consumer sectors, both cyclical and defensives, and communication services sectors, TMT, minus technology, are still trading at a decent discount to fair value. But we would be very selective here because we've had some names that have really moved up very sharply. We probably prefer quality names still. So we still like a Tencent, for example. We still think there's good upside there on the virtue of what the Tencent business is doing anyway. Other cyclical names would be recovery in obviously restaurant business for Yum China, for example. But I also like to point out that really the huge discounts are still being seen in the small cap names, but those are the ones that are going to be more volatile if there is disappointment. Probably some of the another area that we think is attractive is energy, given what's going on with the geopolitics in the Middle East. We probably think that given that the energy names have pulled back in the third quarter, we think PetroChina might be a good name to go into for the fourth quarter.
And there are so many economies and markets that are heavily exposed to China, right? So are there any stocks across Asia that you would like that could get some upside from their exposure to the Chinese market?
Yeah, so we've seen the factory automation names in Japan sort of underperform the rest of the market because of their exposure to the China market. The revenue sales have disappointed a little bit cyclically. So if there's a fiscal spending news that we anticipate could come out in the near term, that should actually lift factory automation names. The wide moat, the widest moat name that we have on our list there is probably Fanuc. But across the board, there's selectively other names as well, including Yaskawa and Harmonic Drives.
Lorraine, always great to have you with us. Lorraine Tan, who's the Director of Asia Equity Research at Morningstar. Coming up on the Asia Trade, we're live in Taipei. The world's biggest iPhone assembler is set to unveil a new EV as it seeks to diversify its growth engines. We get more from Hon Hai's Tech Day next. This is Bloomberg. Taiwanese industry giant Foxconn is holding its annual Tech Day in Taipei. The company, known formerly as Hon Hai, is the largest contract electronics maker in the world. It's now pushing to diversify and build more future-proof income streams. Our tech reporter Annabelle Jewellers joins us now from the event in Taipei. So, Belle, what's the mood on the ground?
Well, the mood actually probably hasn't changed too much from the last out of this one. It's still these ongoing checks that are happening, but it really just puts that emphasis on how important this day is to Hon Hai, because they wanted to go off without a hitch. It's the 5th time they're holding this. It's the 50th anniversary of the company as well. And as you said, it's the first growing importance that we see of this business, because it's going to be open to the public tomorrow. A lot of people are really interested in the types of products that Hon Hai is putting out to the market. Some of those are the EVs, and you can see them behind me. We'll get more from the EV head in just a moment. But a lot of people today will be interested in what's off to my left, which is the AI supercomputing center. And what Hon Hai is doing is really creating quite a big lead in the market for AI servers in particular. So it's working with the likes of NVIDIA to produce these AI servers that go off to the hyperscalers, the likes of AWS, Amazon, Alphabet, Microsoft, to really build up this cloud infrastructure. That is the big focus for Hon Hai today. And again, as I said, a lot of people are going to be interested in what the company is doing in this area in particular.
Annabelle, so what conversations are we expecting for the rest of today?
Well, lots of great interviews ahead. We're actually going to be hearing from the chairman in just a few hours' time. We're going to be speaking with Pininfarina, which is the Italian designer of some of the EVs, as I said, behind me. We had an interview yesterday as well, the day before, with the head of the man that's leading Hon Hai's EV rollout in this space, Seki, and he spoke about the sort of capitalization or the market share that Hon Hai is trying to capture. So 5% is the goal for the near term. Take a listen.
We have a logic. EV build will be same as laptop or smartphones, and in that area we have over 45% market shares. So I don't know how long it takes, but 40-45% is our goal for this area, and then let's say revenue will be very high.
I think about what's perhaps one of the most established contract car manufacturers in the world, and that's Magna, that's producing for the likes of BMW, Mercedes, Audi, and their revenue last year totaled just over $40 billion. How do you see that market share being exponentially greater than a company that's decades established?
We don't also talk about our competitors, but most of our competitors are doing CMS. Not CDMS.
Where are the regions that you're looking at in particular for this to be a success?
US, Southeast Asia, and Japan. And then, of course, US, it's a very, very large market. In short, we have to say now difficult to determine. We are waiting for election of president. That may influence on our subsidiaries, customers' decisions.
How would that influence the decisions of your subsidiaries? Do you mean about convincing more of your suppliers to set up manufacturing bases in the US?
Just removing uncertainties. There are many uncertainties. That's maybe customers' conditions. They doesn't want to determine now. most of the decision is waiting for their decision.
So is it fair to say that you've got a number of Taiwanese suppliers that are sitting right now waiting for the outcome of the US election to determine whether they want to move their manufacturing bases there as well?
It's depending on the product, but if you're talking about EVs, I think many, not only us, but many of players is waiting for that decisions.
And is there any specific outcome that you're looking for in the election?
No. We are flexible. We are 50 years experienced companies. We already experienced many of the presidential elections, and then we mitigate risk and maximize opportunities.
Some really interesting commentary there, because we know if Hon Hai is going to be able to succeed in its EV goals of reaching even up to 45% of global EV production worldwide, it's going to need to be able to develop that ecosystem, and that does really rely on a number of its subsidiaries being prepared to set up manufacturing bases outside of Taiwan. So certainly a big watch point, and as we said, many of those watching for the outcome of that vote in November in the US.
Annabelle Jewellers there in Taipei. We have more ahead on the Asia trade. This is Bloomberg.
South Korea is looking ahead to FTSE Russell's announcement of membership changes on Tuesday. Seoul is hoping it finally made the cut for a key bond index after overhauling currency and debt market operations. Let's bring in Asia credit editor Finbar Flynn. So Finbar, how consequential would this be for South Korea in getting these new fresh funds?
This would be a big deal for the government, because they really need to get more people and more overseas investors into their bonds. And by doing so, the government has said they expect about 67 billion in additional funds flowing into their local government treasury bonds. And I mean, the name of the game here is to get yields down to lower borrowing costs, and that's what Korea really needs.
And Korea has been up for inclusion for like 2 years. So what's been the issue so far?
So the big deal for Korea, and the reason it hasn't got in so far, is the accessibility of the market. Now, the government and local authorities have been doing a lot to improve the measures, but people like Goldman Sachs say maybe this may not even happen this time. It may go into 2025.
And their stocks apart because of the short selling ban also could be an issue?
So Korea is a bit more regulated than a lot of the more developed markets. So the index people are very conscious of this, and they're looking at it very carefully.
At the same time, we know that, India's been making progress despite being seen as a reform laggard, right? What do we know across the rest of, the other sort of emerging markets that might be making progress this time?
So as you mentioned about India, India is also on, people are going to be looking out for the result later our time tonight to see if they get included into one of these FTSE Russell indexes. And for them also, the people are very interested in investing in India now. The government has taken all these measures to make the country more accessible to overseas investment. So people are interested to see if that's going to work out later.
Will there be market implications, especially in the next few days after the announcement?
That's hard to gauge, but because this takes a bit of time to work through, and there's these international trading clearing houses that have to make this all come to happen. So we probably won't see something huge, but I think, as you saw in India in an early index inclusion recently, it could have a sizable impact over a small amount of time.
How much demand is there for EM debt and stocks as well, right? Do we see the impact of lower global yields and how that changes things?
So everybody is sort of interested in bonds now, because we have seen the beginning of the rate cut cycle, and that's happened in a number of the different economies here. So you get that extra pickup on EM bonds over developed bonds, and with the different central banks pulling down rates here now in the region as well, there's an awful lot of interest to get back into EM bonds.
Finbar Flynn, good to have you with us, our Asia credit editor, as we look ahead to those potential inclusions coming from FTSE Russell today. And these are the latest from the corporate front. Alphabet shares closed lower after U.S. judge ruled it must lift restrictions preventing developers from setting up rivals to its Google Play Store. The move could upend Alphabet's dominance in the Android app market. The ruling comes after the firm lost an antitrust case to Epic Games, which accused Google of abusing its power in the market. Tokyo Metro has unveiled a provisional share price of up to $8.10 for its IPO, projected to be Japan's biggest in 6 years. The range values the subway operator at up to $4.3 billion. Tokyo Metro is looking to raise at least $2 billion at a time when the Japanese stock market looks to be on the mend. Shery Holdings is said to be considering a Hong Kong IPO for its automotive unit that could value it at more than $7 billion. Shery Auto is one of China's biggest car exporters and one of the few not listed. Bloomberg reported last year that Shery had previously considered an IPO in mainland China for its auto arm.
Take a look how futures in Europe are opening up as, of course, we're keenly awaiting that reopening of trading when it comes to onshore markets in China after the week-long holiday. A little bit flat when it comes to German DAX futures and Euro Stoxx 50 futures there, despite a lift in the previous session. Some of that deal-making news flow has really been sort of one of the proponents of the upside that we saw, and we saw the earlier kind of a slide being reversed as well. Also some signs that the ECB is gearing up to cut rates, also helping sentiment there as well. Some of those single stocks that we've been watching when it comes to luxury as China reopens. We'll be getting some more details as to spending over the week-long holiday as well. So the likes of Richemont will continue to be watched. That gained over 2% after that deal when it comes to Net-a-Porter to Martha was announced as well. But overall, as these the boost, I should say, from China potentially fades, we could see European stocks facing some challenges on fresh records. This is Bloomberg. We do have the minutes of the RBA meeting, and of course we're looking for more details as to whether there's further justification, if you will, on the hawkish pause that the RBA is sort of stuck at the moment. The review talks a little bit about the goals of policy optionality, but that the eco-data risk assessment will guide the future policy path. They're vigilant to upside inflation risk. The CPI goal remains the top priority. That policy needs to stay restrictive until there is confidence on prices. They discuss scenarios for prolonged restrictive rates as well as further hikes, that the labour market is still tighter than the full employment estimate. Each outcome conceivable given uncertain economic outlook. So really the RBA kind of suggesting that all options remain very much on the table at the moment, saying that the early data suggests a risk of delay to the pickup in consumption. We have seen an improvement when it comes to consumer confidence as well as retail sales, suggesting that we saw better spending levels most recently. But it does look like the RBA will be holding rates at the current 12-year high until there is confidence that inflation is moving sustainably towards its target band. So that tells us that policy easing remains some way off. Some of those scenarios where they reviewed that easing might be required, but also that further restrictive measures might need to stay in place for longer there as well. So I don't know if this gives us much more clarity on the policy conundrum, but it certainly seems like anyone hoping for a sooner start to RBA easing alongside these other global central banks, Shery, might be disappointed.
Yeah, take a look at how the ASX 200 is trading at the moment, because we're seeing it be the only major market barely in the positive right now. Energy, materials leading those gains. Morgan Stanley just raised Australian stocks to overweight. Of course, we have seen a lot more optimism given that China's stimulus measures are now boosting some of those China-exposed stocks. And of course, Australia, very China-exposed market. Morgan Stanley also reducing its underweight allocation on Chinese stocks. Futures have been up more than 15% while China was away on Golden Week holidays. So we could see this rush of buy orders at the open. Brokerages and stock exchanges in China gearing up for that frantic Tuesday when onshore markets reopen after a week-long holiday. Optimism running high. The Beijing stimulus measures will give shares another leg up. For more, let's bring in China correspondent Min Lo in Hong Kong. It's going to be a busy day.
Yeah, indeed. We're going to see huge numbers of retail investors piling into the stock market today, just judging from the interest, the surge in interest in new account openings over the Golden Week holiday. Brokerages are recalling their staffs back from the holidays to cater to client inquiries 24 hours a day. And we know that stock exchanges as well has been carrying out stress tests to ensure that we won't see the sort of glitches and delays that we saw 2 Fridays ago before the Golden Week holiday, when that overwhelming amount of trading activity really overloaded the system. And we're also seeing some banks bringing forward operating hours to extend the sessions for consumers to carry out certain transactions as well. And if Hong Kong equities are anything to judge by, we've seen the Hang Seng China Index rise some 11% during the Golden Week holiday. So we're set up for a monster rally when mainland China markets open today. And of course, that NDRC meeting as well, depending on whether officials meet or beat expectations there, we could be up for a roller coaster ride today.
Yeah, and we are kind of looking ahead to that policy briefing, right? The question is whether there's going to be more fiscal announced, which is obviously what investors are looking for, or do you think it's more likely that we'll just get more details as to what's already been announced?
Yeah, just judging from who will be present at the briefing today, which are the officials from NDRC, the top economic planner, we're expecting more details of how the existing or perhaps incremental economic policies are going to be implemented. Many economies are expecting a fiscal boost to the tune of 2 to 3 trillion yuan, but that is usually decided by the State Council. It has to be approved by the legislature, and then Ministry of Finance, that's an agency that issues a special sovereign bond. So that's where we're likely to hear any news from an additional sovereign bond issuance. So given that these officials from the State Council and the Ministry of Finance, they're not going to be present today, we're not likely to hear a number in terms of a new fiscal stimulus. So more details will be around whether there will be measures to shore up consumption, for example, or investment, as well as whether the NDRC officials will loosen the restrictions when it comes to the usage of local government bond funds.
And Mimi, we're already seeing some strong data when it comes to home sales during Golden Week. What sort of holiday spending numbers could we expect?
Yeah, we don't have the official data yet that will come in later today, but preliminary unofficial data from Meituan, for instance, they are saying that they are seeing a 40% increase in-store dining consumption and about 70% increase in travel-related, in total spending, daily spending, I should say, on Meituan platforms. So that's pretty robust numbers that we're seeing, but of course, total spending is not the one to look at. We really want to pay attention to the per capita spending that will give us a better sense of whether consumers' confidence have really returned this time around. And of course, there's a lot of shopping for homes as well. CCTV, the Chinese state TV, reporting that visits by home buyers had increased by 50% during the Golden Week holiday, and home sales in Shenzhen, for instance, jumping tenfold in the first 6 days of October. So very immediate impact that we are already seeing from some of the measures that were sketched out by the PBOC before the holidays.
Bloomberg's China correspondent Min Min Lo there. Well, the stimulus-fueled rally in Chinese assets driving record inflows into exchange-traded funds by the nation's stocks. Joining us now is Bloomberg Intelligence ETF analyst Rebecca Sin. So what are we seeing in terms of inflows?
So as Mimi was saying, it's been Golden Week, so the mainland China market has been closed. But we can expect a monster rally today. And so in terms of what has been happening, offshore ETF has seen a record number of ETF inflows. If we look at the global ETF inflows, 6 out of the top 10 are Chinese ETFs. So for instance, you have the likes of iShares China Large Cap, the FXI US ETF that's listed in the US. They've seen a record number of inflows in the past week, $3.5 billion. This fund is only $9 billion, so 30% of the AUM came in the past week. The other ETF that tracks Crane Shares CSI Internet ETF. This is often the institutional investors offshore that want to have exposure into China. They've seen a record of $2 billion in assets under management of inflows in the past week. And so this ETF is only $8.5 billion. And so if we look internationally in the past week and past month, we've seen $8.5 billion worth of inflows into Chinese ETFs. If we looked at this a few months ago, offshore Chinese ETFs had zero inflows. But if we look onshore had a very different story. So the national team was buying ETFs. And so this year, if we look at onshore mainland China ETFs, we saw roughly $127 billion. And around 100 billion of this came from the national team. And so if we look at where the flows are versus onshore and offshore, before the holidays, we had a very different story. Onshore was seeing huge inflows supported by the national team, while offshore was seeing very little inflows. But due to the stimulus in the past week, this has now flipped. Both on and offshore ETFs have seen huge inflows, which means institutional and retail investors are now looking into investing into China and view it as a market that may be considered cheap, and they expect the market rally to continue.
Are regulators supporting these new launches?
So in terms of new launches onshore, regulators are being very selective in what they're investing into. So for instance, we've seen that out of 7 out of the 10 ETFs with the most inflows, they're really the large cap, so the likes of CSI A50 index-based. And so with a lot of the ETFs that the national team has purchased, they're really purchasing the large cap, CSI 300, CSI 500, 1000, SSE 50, Star 50. And so of all of the new launches, a lot of them are not gaining the attention that the regulators or that the national team wants. And so, for instance, if we look at the eFund CSI A50, it has the most inflows year to date with 613 million. So for a lot of the new launches, it's very difficult to get the regulators involved, and they're very selective. They're really picking the large Chinese index like CSI A50, CSI A500 could be the ones that are next in line for new launches that the national team supports.
Rebecca Seen there, Bloomberg Intelligence ETF analyst, as we await, as Rebecca put it, that monster rally perhaps in the Chinese markets reopen. We have more ahead on the Asia trade. This is Bloomberg.
Consultations have now closed on the Australian government's plans for laws around the development of artificial intelligence. Voluntary restrictions introduced last month may soon become mandatory. Bloomberg's Paul Allen joins us now with more. So, what do we know about the new rules and what they look like?
Yeah, well, the consultations on this closed on Friday. We had a long weekend, so now we're just waiting to see what gets legislated. But an expert panel recommended 10 guardrails, and I won't run through all of them, but the common thread through all of them is transparency. Meaningful human insight, control and intervention where necessary, that was one. Making sure end users know that something's been generated by AI and decisions, interactions, content is AI generated. And also a process for people who are affected or impacted by a decision AI has made to challenge those outcomes. So of course this technology's not going anywhere. The challenge now is to regulate it, and the opportunities are huge. The Australian Tech Council has an estimate on this that AI could be worth up to $77 billion to the Australian economy by 2030. But of course the risks are unknown, and the Science Minister Ed Husic calls this one of the most complex challenges that the government faces.
What sorts of measures in terms of the ability to regulate, particularly when it comes to the financial system, are being considered?
Yeah, that's a specific corner of what's being talked about here. The RBA's been weighing in on this. It's worried about things like the amplification of herd behaviour, credible misinformation, deep fakes, they can take off very quickly as well. And also the opacity of AI models. They're just so complicated, it's hard to tell what's actually going on inside the AI and how reliable those models are as well. And anyone who's ever messed around with some of these AI tools knows how easy it is to trick them, to get them into saying something crazy. Sometimes they hallucinate as well. So the RBA is part of the Council of Financial Regulators, and they're working on plans to monitor and adapt AI. But again, the goalposts are moving all the time. If there are concerns in those current guidelines that aren't addressed, it could well be that new ones get added.
It's quite interesting seeing some of the efforts being made by the government in terms of the broad landscape of being able to regulate tech, right?
Yeah, and this is something that Ed Husic was talking about. Just the challenges here are incredibly complicated. I mean, you know, we saw how the internet revolutionized society. It tore down everything around it and then rebuilt everything with itself at the center. And we're seeing a second revolution along those lines right now. So with progress, I think it was the NVIDIA CEO, Jensen Huang, who said, look, we're moving at Moore's Law squared now. So the progress is so fast and the regulators are so slow in trying to catch up. The challenge here is to come up with a meaningful set of regulations that will serve into the future. And, as Ed Hughes says, this is an incredibly complex challenge.
Bloomberg's Paul Allen there with the latest. We continue to really look for sort of some of the broader interpretation on what the government could potentially do in these AI guardrails and regulation. Taking a look at how we're seeing the tracking when it comes to Australian assets at the moment, there's a couple of themes at play. We did have the RBA minutes a little bit earlier, really wanting to maintain that view that getting to that inflation target sustainably is really still the top mandate for the RBA. So broadly, the takeaway seemed to be that there's not sort of any indication that we could see sooner rather than later easing being kicked off by the RBA, the way that we've seen perhaps some of these other central banks done. At the same time, we've also got Morgan Stanley's equity strategy recommendation. When it comes to Australia, we saw a bit of a move there, raising Australia to overweight as a defensive play and at the same time scaling back that underweight China position as well. So there's a lot going on when it comes to geopolitical risks, China sort of comeback, the US election, policy uncertainty from central banks going into next year as well, all weighing there. We've seen a bit of a turnaround, though, interestingly, when it comes to Australian stocks. Some of the financial and banking drags have now kind of been countered a little bit. We're seeing 0.25% up when it comes to trading on the ASX. Australian bonds are also trading today. A little bit of underperformance there, given we had the holiday yesterday. And the Aussie dollar seeing a little bit of a move higher, 67.68 on the back of those RBA minutes. We also had some fairly encouraging consumer confidence numbers, still deeply in pessimistic territory, but it did show that there was some improvement. In fact, an improvement to a 2.5-year high for Westpac consumer confidence, despite still a lot of concerns on the household and family finances sector that suggests that more improvement needs to be made when it comes to alleviating cost of living pressures there. But that RBA set of minutes really very clearly signalling that that key rate will stay at 4.35% at that 12-year high until it is absolutely confident that inflation is moving sustainably towards that target band. So really giving the takeaway to investors that policy easing still seems some ways off here. We do have more ahead on the Asia trade. This is Bloomberg.
Chinese equities have been underpriced. We didn't time it. And we know that when markets open again tomorrow on the mainland, there's a possibility of a pullback, but our view is long-term. Now, in that context, the initiatives that come out tomorrow probably are continuing to support the consumer first, and then moving on to other industries as well.
At some point, the cycle turns. It's better if it happens quicker because of government action. But it would have happened anyway just because of the cycle. Some companies would have gone out of business, etc. So on a long-term basis, we think it's the right place to be.
It's a bit different because I do think we really had like 3 days in a row of kind of waves of positive signal surprise. It's a bit departure from the usual policy support. They've already been giving so many positive signals. It would be kind of counterproductive if they disappointed the markets at this point.
Some of our guests there with the outlook for Chinese.
Yeah, for Chinese stocks as we count down to the reopen of mainland markets, Haidi, and of course this as we continue to watch really those APAC bonds at the moment and those big moves across the board that we're seeing. The 10-year bond yield really continuing to rise ahead of the market reopen in the mainland. This, of course, as overnight we have those treasury yields surging all above that 4% level. What a difference really a few weeks it makes, right? I mean, for the first time since August, money markets implying fewer than 50 basis points of rate reductions through the end of the year when it comes to the Federal Reserve. And same thing with China right now. After we had that incredible bond market rally on pessimism about the Chinese economy, now with all of these stimulus measures, we're actually seeing that reverse course. And Morgan Stanley even reducing their underweight allocation on Chinese stocks, and futures now have gained in the double digits while China was shut, which is sort of indicative of perhaps a rush of buy orders at the open. And Haidi, all of this, of course, as we are also setting up for the National Development and Reform Commission, the top economic planner, coming out with more details on putting that stimulus package into action.
Yeah, investors would be hoping for some more policy surprises, particularly when it comes to maybe some more fiscal investment and fiscal policy easing. But it does feel like perhaps we'll just get more of the details fleshed out in terms of the stimulus measures that have already been announced, which of course have been heavily on the monetary policy on the stock market side. But let's get some more on what we can expect from the China reopening, because expectations are high. We know that some brokerages didn't actually get much of that holiday in terms of bracing and preparing for the volumes and the new account openings that have, according to CCTV, hit at that record high in terms of the retail investors that are really just trying to get into this market. It's a real indication of just how devastated valuations have been and how big the sort of sense of urgency that we've seen in that turnaround. Let's bring in Bloomberg's Mark Cranfield. And Mark, the question really is this just a tactical rally that we're seeing, or is it something more strategic, more long-term, something with stronger fundamentals?
Yeah, well, I think the amount of money that's flowed in even before the Chinese break and then continued throughout the Hong Kong markets over the past week would suggest that this is really something more than just a one-off move. I think investors here are coming in from all corners of the world. People have been extremely underweight for all things China for a long time, and they seem to be buying into the idea that this is a turning point. The fact that you've got monetary and fiscal policy working together in a very strong fashion is really convincing people that it's not just about boosting the equity market, it's also about the economics, about the underlying economy and getting that back onto a sustainable growth path. So it'll be pretty surprising if this reversed quickly. Of course, it's going to be a pretty wild start today. We could see some very erratic moves, particularly in onshore equity markets as they play catch up to what's been going on in Hong Kong. And even people having mixed expectations about how long it will take to get the Chinese economy back on, say, a 5% growth path. But certainly the seeds have been sown for a very serious turnaround. And you can see some of the analysts, some of the major houses are now calling for much bigger rises in Chinese equities. So this looks as though it's the real deal.
Are we going to see that upside for the Chinese yuan as well then?
Yeah, it would definitely. You could see it was benefiting from the flows before China went for its break. You could see the currency was starting to gain with the amounts of money that were coming in. And the Hong Kong dollar is a very good indicator of what to expect. We saw incredible demand for the Hong Kong dollar as people were using it as a proxy for getting into the Chinese market. So that money surging in to the 8 shares and to the Hang Seng Index was pushing up the Hong Kong dollar. You can see that demand is so high that the HKMA is having to add extra liquidity to the banking sector as people draw down money to go into equity. So that's a very good sign that as the money flows in, the currency is also going to appreciate as well. It's pretty likely that we will see a stronger currency. Of course, the PBOC will probably push back a little bit. They don't want it to accelerate too quickly. That will affect the export sector. But when you've got this much attention on Chinese markets, it'll be surprising if the currency can't rally at the same time.
We've got a great piece out on the sort of risk of Japanification for Chinese stocks and broader risk assets, right? How important is it for policymakers to really be able to double down on the momentum that is, in place at the moment, to be able to avoid reverting back to that sense of depression? Because we have seen kind of the example of how hard it's been for Japan and Japan's share market to be able to crawl out of that once that malaise has set in.
In the past couple of weeks, and you look at the kind of numbers which they're talking about throwing at their markets and at their economy, this is really a situation where they cannot afford to fail. If this goes wrong, if investors lose confidence again in Chinese markets, that could be it for, as you say, it could be a Japanification type situation where people could be put off of investing in China for a very, very long time, maybe for a decade or something like that. This cannot afford to go wrong. The fact that the PBOC led all of this, that was the first person to start moving by lowering interest rates and talking about stabilization fund for equities, that has boosted confidence a great deal because people see the credibility of Chinese central banks. It really is a situation where they cannot afford to get this wrong. Otherwise, they could be locked out of global investing for a considerable period of time.
Our MLive strategist Mark Cranfield there. Great to have you with us with a preview of the Chinese market opens. We're expecting a huge pop there coming back from Golden Week holidays. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.